make the jump to buy a motorcycle, and I bought the one that you're seeing on the screen there, and it was a very specific purpose, right? I needed an inexpensive motorcycle to kind of train on, learn how to ride, keep it pretty local, but really just kind of a budget starting point. And then after a while, I realized, this is great, but I kind of need something more. I need some additional things. You can notice on that bike, it's not really designed for long trips. So I went and upgraded to a little bit more of a touring bike, and I went with a Yamaha, partially because of the cost. It was really, really inexpensive. But it gave me that next level of features and options that I wanted. So I was able to go on longer rides. It was a lot more comfortable. You can see it's obviously better for a passenger. And then really after a little while, I decided, you know what, I want something bigger. I want something better. So I decided to go with the Harley Davidson. And part of the decision on that was the customization that I could do with it. I could do and make it my own. And this is a lot of what we're talking about when it comes to life insurance. We can buy something to start with to get our feet wet, make sure we have the protection, make sure our clients have the protection that they need. But then as their needs change, they might need something a little bit longer term, something with some more features and some benefits. And ultimately, I kind of liken the Harley to an indexed UL, in that the customization is really what comes into play. You can really do some things with indexed universal life that you just can't do with other products. And that allows the customer to make some decisions about what their goals are, what they really want out of this insurance. I mean, everybody obviously wants the death benefit protection. And as we've talked about on these series of calls, Protective is very focused on death benefit protection and those guarantees for customers. We want to make sure that the products that we're selling and that the customers are purchasing are there when they need them, and their beneficiaries are going to be protected as close to originally possible as when they bought the policy. So indexed UL is that product that you can customize a lot. You can do a lot of different things, so that when a client says, I need this, but I also need this and this, you can build those things in. So that's really what we're going to focus on today. And for those of you who haven't been on these calls, Protective, I just wanted to mention a couple of quick things. I mentioned we're dedicated to that protection space. So even on today's call with the index life stuff, you'll see that we don't have a lot of complexities built into our index, which makes it easy for you to be able to explain how these work to customers. But it also makes the customer feel more comfortable that they understand what they're buying. And we have a long history of providing very clear and transparent, easy to understand products that meet those clients' needs, whether that's short-term, affordable coverage, or something along the scale of an accumulation product like we'll talk about today, and then really anything in between there. And we try to do that, or we have done that, kind of using a selling experience that you, the agent, the advisor, can get used to, and it's across all of these products. It's the same way that you actually interact with your customer, what you interact with Protective. We feel that brings a little bit of a higher level of efficiency to you as you work on solutions for your customers. So we've been around for over 115 years. We've grown significantly in the last 5 years. We have about $1 trillion of life insurance in force. And that number in the middle is really where I like to focus, because ultimately that's why we're in this business. We paid $4.9 billion in claims to over 887,000 beneficiaries in 2021. So ultimately, everything that we're talking about today, everything that we've talked about on these past calls, has really been focused on that. When that client needs that coverage to be in force for the benefit of that beneficiary, they want to make sure that it's there, that it's with a company that's reputable, and that it's as close as possible to what they originally bought. And that's really where we get into the index conversation today. So we'll go over a couple of things. We'll go over the mechanics of IUL. We'll also go over kind of the advantages that IUL can bring to you as you're working with customers, but then also ultimately to the customer and what they're trying to accomplish. And then I'll mention a couple quick things about how this all ties in and how you work with Protective. So if you guys have questions, feel free to type them in the chat. I know we've got a small group. So if you want to type those in, I'm not sure, Jamie, if you want to maybe bring those up as they come up, or if we can certainly spend some time at the end as well. So you've seen this on our past calls. This is just kind of a recap here of what we deal with Index Universal Life. What are we looking at? We're looking really at death benefit protection, of course, potential for lifetime coverage, but we integrate a fixed interest rate as well as some cash value growth and access. Flexible premiums are part of it as well, but then we add in that market participation, something we didn't have on the universal life that we talked about last time. So we actually get the benefit, and the customer gets a benefit of having some participation with market performance to help that cash value grow more than just what a fixed interest rate would be, like we would see on a universal life contract. So we're adding that additional piece to this. So the benefits of indexed universal life really come into play when we talk about just that, the cash value growth. We have flexible premiums, which we had in the universal life. We have the death benefit coverage, but we add that additional cash value potential and the access to that cash value. And then it also offers some protection if the market drops, right? So we'll talk about how that works. The downside to index is it is usually more expensive than what we've talked about in the past, the term and the guaranteed UL. So you've got some higher premiums that a customer has to get comfortable with to access all of these benefits and features. So let's talk a little bit about how index works. And again, I'm going to try and keep this as simple as possible so that we can really just get down to how this policy functions. And it's going to be relatively the same with every insurance company, although all the mechanics of it and the underlying accounts and the crediting rates and strategies will vary. But simply the client will make a payment and there's a premium load that is deducted. That premium, we will take the policy charges and the expenses out, and then the cash value will grow based on that amount that's remaining. So whatever premium isn't covering all of those expenses and charges will go into an account, and each allocation will be measured over a certain period of time. So if you're paying annual premiums, that premium that's remaining after we've taken everything out will then go through and be credited based on an annual basis. So a point to point from one year to the next. Sometimes they're monthly, and those are known as index segments. They're subject to a maximum cap rate. And there also is the opportunity for a fixed interest account, which again, we'll talk about in a little bit. So clients have a couple of options, but that's the mechanics of how premium is paid. Company takes out some expenses and the costs. The remaining amount is then applied, or the remaining amount is subject to that crediting rate. Clients at any point can access those cash values through either withdrawals or loans. That can be used to pay unexpected expenses and be used as a financial resource for them. It's very important to note that when customers start accessing funds, it can change the nature of how that policy works, especially the guaranteed provision. So you want to make sure and help clients understand that yes, they have access to all this stuff, but it can change those guarantees from a negative perspective. Once death occurs, then that policy benefit is paid to the beneficiaries tax-free, just like we would see on a traditional life insurance design. So let's look at how those segments work, because that's where usually the confusion comes in. So I've broken it down very simply. We're going to use an annual point to point, which means we're going to look at the premiums that are deposited today, and we'll look at how that impacts it in 1 year. Again, you can have monthly segments as well. But we're going to look at a couple of different scenarios of how this works. So we're going to assume first premium the client pays comes in on January 15th. That premium is then again, the charges and the fees are deducted out of it. And then 1 year later, we're going to use in this account the S&P 500. So the S&P 500 over that 1 year, from January 15th of 1 year to January 15th of the next year, that returned 13%. So it was a good year for the S&P. For the index policy, we're going to credit the cash that was remaining in that segment up to the cap, which for this example is 8%. So the client is going to have an 8% interest rate credited to that premium that is in that segment. We're going to look at February's payment. Client pays a premium in February, the very next month. And the S&P from that February to the next February returns a -8. Well, you can see here we have a 0% floor, which again, most index policies are going to have a 0% floor. Some will have a higher floor, a 1 or a 2%. Sounds really good, but you got to remember that's part of those policy expenses that are going to come out of that premium. So if the client is paying money in all of their premium payments to have a higher floor, that might only apply in some of those segments. So you want to keep those expenses in check and take a look at that. So for that month, we're going to not credit for that segment. The next year, we're not going to credit anything, but we're also not going to take anything away. And that's the real difference between an index product and, say, a variable product, where the funds that are in that account could actually lose that 8%. The client here is getting the benefit of the credited interest rate, but without that risk of losing any additional policy value based on a negative return of the index. Let's look at the next segment. It's paid in March 15th. We look at March 15th of 1 year to the very next year, and the S&P had a 9% gain. We're going to credit that premium that's in that segment up to 8%, again, because we have that cap. So they're losing out on that 1% gain. But again, remember, they did not have to participate in that 8% loss. So that's the trade-off that a client gets. And then in the April segment, we're looking at it, and it returns a -12. So again, we have a 0% floor. So the client will retain all of the funds that are in that segment. So you can see how from segment to segment, you can have pretty wild swings based on the S&P 500, which is our example here. Now, keep in mind, the funds that we're talking about are not invested in the S&P 500. And that's an important distinguishment to make here. In a traditional variable product, you will have those funds. You will buy those underlying funds. So you're actually invested. The client is actually invested in those funds. There is not a fund that is actually invested in here. This is the insurance company keeping that money in a general account, and then they will credit whatever the return of that index is. So client doesn't have to worry about their money being out in the market. They just need to worry about what that market, whatever that index was, how it performed over the period of time that applies to their segment. So you can see the advantages of having an index policy here is you've got all these opportunities where there's a negative return where the client's not losing any of their policy value. They're participating in those gains up to a cap rate, but they're not losing any of those funds. So over a period of time, you can see if you have some significant returns that are negative in the S&P or in whatever index that you're talking about, that can significantly negatively impact an investment that is made in those actual funds or in those indexes. The index life component allows the client to participate in those gains without those losses. So that's kind of a crash course of really how the index works. And again, you've got policies out there that have different indexes. So they don't all use the S&P. They also have different crediting strategies. So annual point to point, monthly, some even have like a 3-year or a 5-year. So they'll look over a longer period of time before they will credit the money that's in the policy with that interest rate. With Protective, it's very simple. And I'm going to go through kind of how our product works so that you can get it. This is hard to really wrap around until you actually see how it works. So Protective has an index policy called Index Choice UL. And it is, again, focused on death benefit protection. So we have some features that are built into it, like guarantees. It has a very low policy expense structure, which again helps that client have more of the premium dollars go in and participate in that index. And of course, you've got the cash value that accumulates in there. So very simple. We use the S&P 500. That's the only index that we use. We do have a 0% floor, which means that they won't ever have those policy losses, but we don't have anything higher than the 0. Again, when you have products that have higher than a 0 floor, that generally adds to the expenses, which means all of those months, even though there might have been a positive return for that segment, that client's paying an expense to have something that's over a 0%, above a 0% floor. And then, of course, you can access the cash value just like you can in most index products. So we have guaranteed no lapse protection up to age 90, and it's dialable or selectable. So if a client feels like they need a death benefit guarantee to age 90, you can do that. If they're more comfortable with 85 or 80, you can pull that down. And of course, that's going to result in better cash accumulation or lower premiums. We have our strongest competitive positioning when you're solving for $1 of cash value at maturity. And all that means is you're paying premiums based on what the performance of the policy will, the result of the policy being the minimum cash that can be accumulated at, currently on the illustrations, they're age 121. What that means is a client can say, I have a guarantee, say to age 90, but the performance of the policy and the cash value will help take me well past that, well past my life expectancy, so I don't have to worry about this policy lapsing before I die. So you can design index policies just like you can with fixed interest universal life products to have a certain amount of cash in certain years, to have a certain amount of guarantee, and kind of anything in between there. As I mentioned, we have the S&P 500. That is our only index strategy, and we only have a point-to-point, which means it's very easy for you to explain to a client what their options are with Index Choice UL. They don't really have any choices that need to be made. It's going to just be one way that they can buy it. It's an 8% cap, 0% floor. Our current maximum illustration rate is 5.21. Now, keep in mind, on an illustration for an index product, whatever crediting rate that you're using on there, which again, ours is 5.21, that's purely a hypothetical rate. It really has no relevancy to how that policy is going to perform because we don't know what that S&P is going to return over each segment. But a 5.21% rate will give the client an understanding that if it were to return 5.21, this is where I would be from a current assumption perspective. Now, that rate is going to vary based on carrier as well. You might have some carriers that have higher rates. You might have some that have a little bit lower rate. And you can always illustrate a lower rate. So if somebody's not comfortable with a 5.21, you could do a 5% or a 4.5%. And most illustrations have alternate rates built in. And we have a 100% participation rate, which means all of those funds are going to participate in that index. So some carriers will have different participation rates based on different caps. So you want to kind of keep that in mind as well. We also have a fixed account. So if clients decide they want some of their premium dollars to participate in that market performance and some of it to be fixed, we have a current crediting rate of 3.25% that's guaranteed never to go below 1. So some clients do choose to have some of that policy, some of that premium participate in the index, but they want to have some that they know what their crediting rate is. And you can do that, and you can mix and match those depending on the client's suitability and their risk tolerance. And you might hear this term a lot when it comes to Index UL, selling the zero. And this has been around for a number of years, but it really appeals to clients that might have been burned in the past on other cash accumulation products that underperformed, again, you're selling a 0% crediting rate as the minimum. So they're not going to have those negative returns. And it's a positive situation for clients who feel like they might be held back by a traditional universal life where they won't get those gains. So we don't have to have any recovery period for those lost years because, again, we're even, we're at zero. So for that really risk-averse client, this is a product that fits very well into their mindset about, I want to potentially get some more cash, but I don't want the risk of losing anything. So keep those in mind when you're talking to customers about why an index policy might work for them and what would be the advantages. So let's talk about some of these advantages. And we're going to go through an example here of where indexed UL would fit compared to traditional universal life policies. So we've talked about the UL policies on past calls, and we'll go through them again here because what this does is this opens up the policy and the options for the client to really access more cash when they need cash. So we're going to look at 3 products that Protective has in kind of how a customer might want coverage to go throughout their lives. So the first product we have is our lifetime assurance. And if you were on our previous calls, you'll know that this is kind of like a term for life type product. So we're talking about a very, very simple pay your premium and it will last as long as you pay your premium. So it's kind of like a permanent term policy. So we've got a 55-year-old that's looking for about $500,000 a death benefit. And they're concerned with costs, but they're also concerned with the value of what they're buying. So to get that permanent product, just to guarantee to age 90, no cash values. This is a guaranteed universal life with no cash values. It's going to be $573 a month. Now, if you remember, we talk about return of premium options, and a lot of universal life products have those return of premium options. And we have that on this product. It's a 25% return of premium if they surrender the policy anytime after the 10th year. So they've got an exit strategy anytime after the 10th year. So if we look at their cumulative premiums to age 90, they will have paid $240,000. If they were to surrender that policy and lose their coverage, which most people aren't going to do, of course, but this will help us understand the cost structure, they would get $60,000 back. That means their net premium was about $180,000. That was what they paid that coverage, paid for that coverage through age 90. Then we can look at more of a flexible premium universal life, which for us, that's called Advantage Choice UL. It's more expensive because it gives the client more flexibility. They can actually get more refund of premium because of that endorsement that's on it. So we have a 50% return of premium at the end of year 21. They have a 60-day window where they could surrender that policy and get 50% of their premium back. And then at the end of year 26, they could surrender their policy and get 100% of their premiums back. So could be an option there when you're looking at 20 and 25-year term for a customer. But this gives the client much more flexibility and much more options. So it's going to be more expensive. It's $688. So in the example on the left, we have a smaller potential for return of premium, but for a much longer period of time, anytime after the 10th year. On the index choice, we have a much larger potential for return of premium, up to 100%, but for a very short window of time. So again, clients' needs and what they're telling you and how they want to have this coverage work for them is really important. We need to listen to those clients because this scenario where they might get 100% return of premium could work great for one client, but might not work at all for another client. Then we move over to the index choice product. Now we're talking a little bit higher premium than the term for life, the lifetime assurance, but it's actually a little bit less expensive than the Advantage Choice. Now, most index products are not going to have a return of premium endorsement or a rider because, again, you're having cash value accumulate based on those segments and the index that are available to customers at any time. Again, it could impact the guarantees, but they have access to that cash whenever they want it. There's no limitation on when they can tap into that money. And again, they can use that as a withdrawal, or they can use that as a loan. We see generally people doing that as a loan because what will happen is that loan will actually accrue interest that the client can pay, but the money that they've borrowed will actually stay in the account and continue to earn interest as well. So it won't impact that cash accumulation on that policy. But you can see here, we've got significant cash value, right? We paid $280,000 in premium. And based on those assumptions that we talked about, 5.21% crediting rate, this is going to return about $311,000 of cash. So we're in a positive cash flow situation compared to the premiums. And again, there's no limitation on when they can access that. So that's one of the biggest advantages you get with Index Choice and with a policy that has cash value is that can be accessed at any time. You don't have to wait for very specific triggers that might not coincide with those clients' needs. It would be really tough for a client to have a financial situation that requires that they tap into some of the cash, but there's a restriction on when you can do it. That's where Index Choice comes into play, or index products come into play, and you can actually use that. And one thing we've done, just so that you know, we've built in this illustration into our system so you can actually look at these three side by side. So when you're talking to a customer, and maybe index policy is the right way to go, rather than going in and having to run three different illustrations to try and piece together what that customer might need, you can run one illustration for our lifetime assurance, and you can see kind of side by side how all of these policies work. And we won't go into this very much, but I just wanted to throw that out there because, again, what we're trying to do is give you the tools that you need to sit down with a customer and have a conversation about what they might initially be telling you is a need, but what you might feel could be a benefit to them just by tweaking the product. And without having to go in and do multiple illustrations, we feel that that's obviously more time, more effective on your time, and can help you have more, more concise conversations with customers and get to the point quickly with them. So what this does is it compares the same premium across all three. So the last slide we looked at was solving for a guarantee year. So all the premiums were different. This will show a client, if I paid the same premium, how do all these policies factor in to my plan? And then you can go in and say, yes, I do like the Index Choice, or I do like the Advantage Choice, but let's solve for this guarantee, or let's solve for this cash value goal. So again, just another tool that we have that'll allow you to go in and utilize that comparison to be able to have those conversations with customers. Now, I want to bring up a rider that we have because it's going to go into our next case study that we'll talk about here, that hopefully a lot of you are familiar with, living benefits on permanent policies. So this is another benefit that customers get when they move from term insurance to permanent insurance. We've talked about those on previous calls, but most of the term policies out there don't have living benefits. And if they do, they're very restrictive and very limited. So our living benefits rider is called Extend Care, and we call it a chronic illness accelerated death benefit rider because that's exactly what it does. It will accelerate the death benefit should a client qualify for chronic illness, should they need chronic illness care. A lot of times this is called long-term care, very similar. They can be interchangeable because they utilize the same criteria to qualify. So with Extend Care, the great thing about this is if they experience a chronic illness, they will either receive all of the death benefit to help pay for that chronic care, or they can receive part of their death benefit to pay for the chronic illness, and then the rest will be paid down to their beneficiary. So it can be any combination of those two. It's 100% acceleration of that death benefit over a period of time. If they never have a chronic illness, then the beneficiary just receives the full death benefit as it would be with any normal life insurance policy. So there's a couple of key features when it comes to living benefits. And again, the reason I'm kind of going through this is because it'll come into play on our case study. But we will pay up to 5% of that death benefit for the benefit that they get. So that's $11,700, which is what the IRS allows a customer to access out of their life insurance policy on a monthly basis to pay for chronic illness. Now, again, to trigger most living benefits riders, it's the inability to perform 2 of 6 activities of daily living. So walking, bathing, eating, using the bathroom, those are all examples of activities of daily living that if someone is unable to do 2 of those, the doctor will certify that they can now tap into their life insurance benefit to utilize that death benefit to help them pay for this care. The other trigger is a severe cognitive impairment. These have to be expected to last at least 90 days. It does not have to be permanent. And once they go on claim, all of the premiums and charges are waived. So they're not going to be losing policy value while they're accessing this death benefit, right? Or this chronic illness benefit, which again is the same thing. If they resume their coverage before the third consecutive benefit period, they'll start paying premiums. If they keep going after that third premium or that third year of receiving coverage, we will permanently waive all premiums, even if they come off of claim after that. So if a client's on claim for 3 years and they decide to come off of claim and no longer receive the benefit, whatever remaining death benefit is in force will stay in force until they die. They will no longer have to pay premiums. And that's a huge benefit for a customer, because that's always hard once you've gone through this type of a situation, this life-changing illness, to have to now worry about paying premiums again when you're not receiving those. So keep those things in mind, because living benefits are, again, another feature that when you add them to the permanent products, and really specifically index, because it works a little bit differently with the ability to have higher death benefits due to cash accumulation, that's an advantage to have over term policies. So let's look at a client situation and kind of how we can do something unique. And both of these policies are obviously protective policies, but I wanted to kind of open the door to show how you can add some additional customization in with some solutions for your customers. So Matt's a 50-year-old that you're working with, and he has an in-force policy. He bought he makes $125,000 a year, and he bought an $800,000 death benefit many years ago. And it was a whole life policy. So he was told, hey, here's this $800,000. This is what you need based on all of what you've got now when he was younger. It's got about $200,000 of cash value. Well, the problem is Matt's income of $125,000, that's not enough to replace his income. We generally talk about 20 times income for someone his age. And that would take him close to retirement age, right? Or actually past retirement age. So he needs a lot more income replacement for the years that he's still going to be working. Should he die, his family is going to miss out on that $125,000 of income. He doesn't necessarily need cash value, but really likes the option. So that's where your trigger is coming in, saying, okay, he likes the potential for cash value. So maybe index products are good because, again, we can get the death benefit protection. We also add in that cash value. He's concerned now with chronic illness. He's got some parents that are aging, and he wants to make sure that his kids aren't in a situation where they have to help take care of him when he gets to be that point. So we can look at an option here where we're just looking at permanent insurance. We're going to go with a universal life product. We're going to go with our Advantage Choice product. Instead of an $800,000 death benefit, we can buy Matt $2.5 million guaranteed to age 95. So we've got that 20 times income, right? So we're covering that need. He had $200,000 of cash value. We don't really have cash value in this product because, again, we're not looking at the index yet. We're just looking at a guarantee, which is where most people go to when they're trying to replace a policy. We can give him that return of premium endorsement. So we've given him some kind of potential for cost recovery, but it's not the same as having the cash value. And we've added that chronic illness rider that we just talked about. So we've covered him for the larger amount of income replacement that he needs for a very long period of time, which, again, that's the challenge because now he's got $2.5 million well past retirement age, which is probably more than he needs because his income replacement will end at retirement, right? But we've given him the chronic illness benefit to protect him. The challenge is he's got about $18,000 of premium that it would cost to fund this type of a policy. So that's probably not going to compare with his $800,000 in-force policy, and it's going to be a very expensive option. So how can we, if a guaranteed UL is more expensive, how do we even start talking about index products that are probably going to be even more expensive when we're trying to help Matt get more death benefit? Well, this is where we get creative, and Protective has a couple of products, the index product being one, but also our term product. And if you've been on our previous calls, you'll remember we have a term policy that functions a little bit differently than most term policies. It will, because it's built on a universal life platform, it will accept 1035 money, which is why it works in this scenario. So what we're going to do is we're going to take that $800,000 death benefit that he currently has, and we're going to turn that into 2.6 million, just over 2.6 million of death benefit. So we've beat what the universal life quote was that we showed, but we've also split it up into two different products. We've got a $2 million custom choice UL. And again, don't get fooled by the name custom choice UL. This is a 20-year term policy that will accept a 1035 exchange and give the client a little bit more flexibility, but it will last 20 years, just like any other term policy would. So we can cover his $2 million of income replacement need for the 20 years that we assume he's going to work. Then we're going to take some of the additional 1035 money, that $200,000 death benefit, and we're going to fund a $674,000 indexed UL product, solving for minimum cash at age 121. So for the first 20 years of this new design, he's going to have $2.6 million. Once the 20 years is up and he's retired and he no longer needs that income replacement, he's got $674,000 of an indexed product that is earning cash value. So that $200,000 of cash value, we've moved that into both of these products. We actually put $77,000 of that into the 20-year term, and we put the additional $122,000 and change into the index policy. So we've been able to use that for both policies to help cover his short-term and his long-term needs. And the long-term need we were able to do with an index policy, which means it's going to generate cash value. Because it's a smaller death benefit, the cash value is going to grow faster than if we had a larger death benefit, of course, because there's less premium dollars being absorbed to pay for the death benefit. So by the end of year 20, Matt has already exceeded that $200,000 of cash he had in his current policy. So we've been able to replace that. We've also got the chronic illness on there, which we talked about. If he should ever need that, he can access $11,700 every month from his death benefit to help pay for those chronic illness needs. And we've done it with no ongoing premium. That $200,000 of 1035 will completely fund both the term policy and the indexed policy. And really what makes this work is because we're not trying to force all of that death benefit into a more expensive permanent product. So instead of a $2.5 million permanent sale, we have a $2 million income replacement sale that is paid completely by the 1035 exchange coming from the other policy. And then we're able to fund the smaller index choice policy that is really more realistic of what Matt needs after his retirement, when he does, again, no longer needs that income replacement, $675,000 funded completely with the remaining amount of that 1035. So what you can kind of see here is a little bit of a creative strategy where you can talk to a customer who needs death benefit guarantees. They need income replacement. They need short-term and long-term coverage. Index is a great product for that, but the death benefit might have to be sacrificed to get the premium that that client can afford to pay. So we're going to split that out, and we're going to cover a short-term need with a short-term policy that is much less expensive, much more cost-effective. And then we're going to do the long-term needs with a smaller death benefit that doesn't have to incorporate those short-term needs. And we do it all with one 1035 exchange coming over from the policy that we're replacing. So really cool strategy there that uses an index policy for all of those things that we've talked about today: the death benefit protection, the potential for cash, living benefits, flexibility. But we've done it a little differently than what we normally see in the industry, which is, since we have to 1035 permanent coverage to permanent coverage, we have to buy everything on the permanent, and we don't need to do that. So keep that in mind. So why would you look at an index policy from Protective? Well, we talked about it's a more realistic approach to the IUL sale. Very low costs, low current crediting rate that is very realistic, 5.21. We've got very simple design with just the S&P 500 and an annual point-to-point. Clients can understand how this is going to work every single year, and it's always going to be the same. We've engaged them in those potential for the positives, but we've limited those negatives, those negative returns with the floor. So hopefully that kind of helps explain a little bit about the index policies and how they work. I think the key is going to be really looking at what that client wants, how complex that policy needs to be to help them achieve their goals. And Protective has a great way to do that. So real quick, we've talked about over the last couple of months here, all the different products that we have. So we've talked about the 2 term policies. We have our classic choice and our custom choice. Again, that custom choice is a term policy, but it does allow some additional flexibility that you can't find in traditional term. We have 2 guaranteed UL policies. Those are in the purple there. One is like a permanent term insurance, where a client simply pays a premium for a period of time, but that period of time can be anywhere from age 90 up to age 90 or lifetime. And then we've got our Advantage choice, which again is a typical universal life contract with all those flexible features we've talked about, including that return of premium. And then at the bottom, we have the Index Choice product, which is a very simple, easy to understand index product that has guaranteed death benefits to 90, but with the potential for cash value and those living benefits that we talked about. The living benefits are extend care riders available on the permanent policies, not on the term policies. And when I mentioned we have an easy process to submit business, whether it's term, whether it's UL, or whether it's the index policy we talked about, you can do it all through our Velocity platform, which is very simply a drop ticket. You submit very minimal information on your customer, and then our Telelife team will call them. We have English and Spanish speaking Telelife interviews available, where we will do all of the work that you would normally do if you filled out a paper application. All of those policies that we've talked about will then run through our accelerated underwriting program to determine if they're eligible. You don't have to choose that, and it is applicable to all of those policies we have. And the clients can either voice sign that when they're doing the interview, or they can e-sign it, and then you can deliver policies electronically as well. So from start to finish, regardless of the product, we have one process that you can follow that takes a lot of the administrative work off of your plate and allows you to do what you do every day, while Protective is in the background working on these cases for you. So kind of the key takeaways here, and then we'll see if there's any questions we can get into. But from the mechanics of UL, we talk about there being an indexed account and a fixed account, and you can usually choose a portion of your dollars to go into either of those 2 accounts, depending on the risk tolerance. There are various crediting strategies out there. Annual point-to-point, monthly point-to-point, 3-year crediting rates. So you really want to look at how long that customer is going to have to wait, or what time frame that customer is going to have that money before they get that interest rate credited to it. Every policy is going to have caps, participation rates, different guarantee provisions. Some will not guarantee to age 90, some will guarantee to 100. I'm not sure if there's many lifetime guarantees left out there. But the policy expenses will vary wildly between different insurance companies. So the advantages of going to indexed UL is you get that greater potential for cash value when you compare it to a fixed crediting rate universal life policy. You get to participate in those gains without having the losses be applied to your premium dollars. And you have access to that cash value, either through loans or withdrawals, really at any point during that contract. So it opens up that option for customers to be able to tap into that. What are the advantages of Protective's index choice? Again, very easy to understand. There are no choices that have to be made when it comes to the index, which is S&P 500, or the crediting strategy, which is the annual point-to-point. We do have lower overall expenses because of what I just said. We don't have a lot of moving parts, so we don't have to charge as much to administer that, which means less of that client's premium dollars are going into expenses and charges and going back into their account to earn interest. And you can dial that guarantee anywhere up to age 90. So it's flexible based on that client's ultimate goals, not only with the protection, but with what premium they need to pay. So a lot of information. Hopefully we kept it basic enough for you, but I don't know, Jamie, if we've got some questions. I know I saw one hand raised, so we can get to some questions if we've got them.
I didn't see a hand raise. I don't see any.
Sorry, I thought I saw a hand raise at one point.
Oh,
there we go.
One.
There we go. So we've got a question in there. Let's see if I can open it. Oh, hold on.
Okay, it's from Teresa Peck. She says, for young couples in their 30s starting a family, their long-term goal being to have retirement accumulation cash and smaller death benefit at the end of life, older age, will this product work?
So yes, so one of the benefits of having an index product is you can accumulate cash, and you can accumulate it however much you need, right? It's all based on how much premium you're paying and how much interest is being credited. So for a young couple in their 30s, I would think absolutely an index policy is great because the horizon that they have to build that cash is very, very long. Now, when you go smaller death benefits, that just means lower premiums, right? So depending on what their ultimate goal is, you could have a death benefit that's much, much higher than the original death benefit because that cash value just keeps growing and growing and growing. So if they're trying to really accumulate a significant amount of cash, there are products out there that are more focused on accumulation. So when I mention kind of the simplicity of our index choice product, it really is designed as a good mix of death benefit guarantees and cash value, but at a very low expense cost. So you will have other products out there that will illustrate different ways to accumulate larger amounts of cash and potentially sacrifice some of those guarantees and some of that simplicity. So you'll kind of want to look at that. We consider our product a protection-based product. So yes, it is great at accumulating cash. It just depends on how much cash you want to accumulate, right? But for a young couple where they're trying to save up some additional money over whatever their retirement plans are going to have, this is a fantastic product. And you could probably, if they're looking at smaller death benefits, you could probably do a short pay scenario where they only pay to age 65 when they retire, and then that policy will just continue after that. So yes, very good scenario for the younger individuals. They'll be healthier in most scenarios. Their premium will be very low, which means that cash will accumulate much quicker because more of their premium dollars will go into the index. So yeah, very good scenario for that couple. What you might want to do though is that combination that we talked about, take a big chunk of what their income replacement would be and use a term policy. Again, that's a really inexpensive way to cover a large death benefit just for a certain period of time. That way, the premiums that are going into the index policy are based on the policy face amount that they would need permanently, and maybe have a dual strategy there. Good question, though. Very good question.
Okay, yeah. And then we had another question. Would it be possible to get a copy of this slideshow?
Sure.
Absolutely.
Yep. I can send that.
Dan will send over the slides, and I can even send over the recording as well. Yeah. I don't know if we have any more questions.
Hopefully you've all had a little experience on the indexed side, but if you haven't, hopefully this gave you kind of a starting ground to just get the basics down and kind of understand it. My suggestion when agents always ask me, how do I really kind of get in and understand IUL? Just run illustrations on yourself. Just figure out what you would want to do. If you were the customer, how much you would want to pay, how long of a guarantee would be applicable for you, maybe what kind of cash values you'd be looking at, whether that's near retirement or to help supplement, some goals in retirement, and just start running the numbers. You can download our illustration software and just play with the illustration and kind of pick and choose. Obviously, Jamie and Lexi, they can help out with that as well. But that's really where you start to see how the relation between the premium and the index accumulation works, how that death benefit can change over time. You can even illustrate it based on pulling some money out in the future so that you can see how that impacts the policy. Just get in and do some scenarios on yourself. Or, if you have kids that are of, working age, do something on your kids and kind of put together a plan for them. And it just helps you really understand how they work. But our index product, the Index Choice, is going to be the most simple product you can use. So I would say to start there. And then you can expand to other products that have a lot more different crediting rates and strategies and indexes. But if you start with those, it can be a little confusing of what do I choose. With ours, you don't have to choose anything. You just put in your goals and it'll do it for you.
Right. That's why we love Protective.
It's fun stuff. And again, the ability to submit all of this stuff through one platform is great. So, don't hesitate to reach out. If you've got some follow-up questions or if you've got some cases that you want to actually look at, feel free to reach out to me, reach out to Jamie and Lexi. We can kind of help walk you through them so you really understand them. But Index can be a really powerful tool when used correctly to help customers really get some flexibility and customize what they want to have in a life insurance policy rather than just, hey, here's a term policy or here's a UL policy. So think of the customization. Think of me out riding on that Harley Davidson where it's customized when you think about Index Choice.
Dan, looks like Brendan has a question.
Okay, so is there anywhere to look to compare an index more to a variable? Well, so as far as us illustrating index and VUL side by side, no, there are a lot of restrictions when it comes to that. So you can't really do that. The best thing would be just to run them both. So if you have a certain goal, if you have a client that says, I'm really looking for this type of a premium tolerance with this death benefit, run it on a VUL and run it on an IUL, and you'll kind of see how they vary and how they differ. But there's not really a tool that I am aware of that you can compare fixed and variable. I think there's just a lot of restrictions around that.
And we also do have the securities licensing and all of the requirements that come with selling the variable products as well, the security products.
Correct. Yeah. So yeah, you can compare just illustrations to each other and see what they do. There are a lot of variable products out there now that have guarantees. It's the same challenge we get into with the index where the more expensive or the more expenses that have to fund certain things can chew up that ability to generate cash because the premiums are smaller. So you just kind of unfortunately have to compare those side by side. There aren't really any tools that I'm aware of that you can do them.
But Brendan, you can also, I believe you can run your VULs on Protective's website, but you can also access WinFlex from Stonehill's WinFlex account. So you would be able to compare any products through there as well. So if you need any assistance registering for that, I can help you.
Yep. The big key there is going to be the crediting rates on the VULs. You have a lot more flexibility to put high assumption rates on those than you do with the IULs. So obviously, if you're illustrating a VUL at 8% or 9%, you're going to see pretty significant cash compared to an IUL that will only allow you to illustrate 5.21% or 5.5% or whatever it is. So keep that in mind as well. All right.
Okay.
I think everybody's ready to get on with their holiday.
Yes, I'm excited. I might even, leave the department up to Lexi for the rest of the day.
There you go. Lexi, you're in charge now. Everybody call Lexi for favors.
She's great. So, anyhow.
Awesome. Well, I appreciate it. Thank you, Lexi. Thanks, Stonehill, for all the support you guys give us. And hopefully this was beneficial for everybody. If you have any other questions or if you want to go into it in more detail, just reach out and we'll get connected with you and work through some cases. So appreciate it.
Thank you, Dan. Thank you, everybody.